In this lesson, we are going to focus specifically on the tools inside Market Monkey that visualize aggressive participation. And by now, you should know that means executed market orders. Everything we are looking at in this section represents trades that have already happened. These are participants who crossed the spread and chose immediate execution. So this is not resting liquidity and it is not unfilled intent. We will cover passive liquidity in the next lesson. So right now, just as we did with the bookmap section, we're first going to isolate all the aggressive sides so you can see clearly and recognize what urgency looks like on the screen before we layer it with structure. Let's start with the footprint cluster candles. So if you look at the chart, each candle is broken down by price level or tick. And at every price inside that candle, you can see how much volume traded at the bid and how much traded at the ask. Now, when a market sell order hits a resting bid, that volume prints on the bid side, which is the left side of the cluster candle. And when a market buy order lifts the offer, that volume prints on the ask side or the right side of the cluster candle. So you can see that here. This is all this tool is doing. It is reporting who crossed the spread and how much size they committed at each price or each tick. So this is how Market Monkey visualizes the market orders coming in versus Bookmap using all the volume bubbles. So now let's go into the settings so you understand why we configure the cluster candles in this way. So when you look at the cluster candle settings under the core tab, you'll notice that we use auto tick instead of locking in a custom tick size. Now, the reason for this is very simple. When you have auto mode engaged, it adjusts the tick granularity based on your zoom level and the resolution, which means it naturally adapts to different volatility conditions without you having to manually change the tick size over and over again. So that gives us the flexibility to see broader aggregation during expansion and finer detail during compression, all on the fly, instead of constantly adjusting a fixed tick parameter as volatility changes. So this makes it much easier to use across different time frames and different zoom in and zoom out levels. So this is similar to how Bookmap changes the volume bubbles, size, and density depending on how zoomed in or zoomed out you are. Next, we render the cluster candle mode as standard, and that displays the sell buy text display or the bid ask display. We also come down here and enable the render profile and set the profile type as delta and scale it per individual candle. Now, delta, again, is the difference between aggressive buying and aggressive selling. So if market buys exceed market sells, delta is positive. If market sells exceed market buys, delta is negative. So rendering delta this way allows you to see where aggression was concentrated inside each candle. And this measures pressure, not direction. So next, we set the scale and grading to each individual candle. Now let's move to the display tab and enable headers here. This gives us a header text on each candle that tells us the total volume and the delta of that candle. We also enable the gradient down here for a visual gradient of this on the candle. Now under the point of control tab, inside each candle, we're going to enable the point of control. And this marks the price level where the most total volume traded during that candle with a border or outline around the point of control. So it answers a simple question, and it's basically answering where did the most business occur during this time window or during this candle. It doesn't automatically mean support or resistance. It simply marks the highest transaction point. So this becomes very important to see when we get to certain strategies later on. Now, under imbalances, we use a ratio of 4. That means one side must trade at least 4 times the volume of the other side at that price level before we get this highlighted. This keeps weak asymmetry from distracting us. We also apply a 25 contract threshold so that very small prints are ignored. So if this threshold is too low, the footprint becomes cluttered with a bunch of noise. And if it's too high, you filter out a lot of meaningful participation. So 25 keeps it readable without distorting the data. So it's just a nice balance there. Now we also require 3 stacked imbalances. And that means 3 consecutive price levels must meet the imbalance criteria before it is considered to be stacked. So this also helps isolate sustained aggression rather than a single isolated print. Now, next, we also enable skip zero values. We also show imbalance outline and color text for these imbalances so that they can be seen very, very cleanly and clearly. Next, under the candles tab, I just choose my layout as bars to display regular candles, but you can also choose hollow, but it's just a personal preference here. And under the aggregate tab, we choose these exchanges here because they're the main exchanges with the highest traded volume. Now, let's move to cumulative volume delta or CVD. Now, just as we learned in the bookmap lessons, CVD tracks the running total of aggressive buying minus aggressive selling over time. So every market buy adds to this line and every market sell subtracts from it. That is the entire calculation of CVD. So in the CVD settings, you can see we are aggregating USD perpetual contracts and not blending spot or inverse contracts into this metric. I have a separate chart dedicated to spot. So I do like to keep things separate for this reason. And the reason is just consistency. So mixing contract types can distort exposure readings because they are calculated very differently. So we want a very clean and structural comparable data set. So we see here that we display CVD as a line, and this just keeps it simple so that you can clearly see whether net aggression is building on one side or the other. And I prefer the line over the candle style, especially when it comes to identifying clear divergences. And I don't care about single candle divergences, so I prefer the line. And again, CVD, it's not predicting any kind of direction. It's just showing you commitment over time. Next, let's take a look at open interest. Now, open interest measures total exposure in the system. When it rises, new positions are being opened and leverage is increasing. When it falls, positions are being closed and leverage is being removed. So it does not tell whether trades are long or short. It just tells you whether money is entering or leaving the market. So we display open interest as candlesticks instead of a line because exposure expands and contracts structurally, and sometimes it does that in one candle. So you want to be able to see those flushes in one candle. So we also apply a moderate smoothing here so that you see meaningful shifts rather than a bunch of noise or a bunch of small fluctuations. Also, in aggregation, we just match that to the same exchanges as CVD. Now, next, let's take a look at net longs and net shorts. These are proprietary indicators built by MarketMonkey, and they're not direct exchange reported long and short counts. Instead, MarketMonkey takes changes in open interest along with price and volume data and applies a weighted model to estimate how those changes in exposure are distributed between the longs and the short side. So open interest tells us total contracts are being either added or removed, but it doesn't tell us which side is responsible. So net longs and net shorts attempt to allocate that change. The combined change in net longs and net shorts will always reconcile with the total change in open interest for that candle. So when net longs increase, it means new long positions are opening or existing longs are increasing in size. And when net longs decrease, it means long positions are being closed or reduced in size. Now, when net shorts increase, the same thing happens, showing you the same scenario. Net shorts increase, meaning net short positions are opening or existing shorts are increasing in size. And when net shorts decrease, it means the short positions are being closed or reduced. So these are modeled estimates based on open interest distribution, not verified account level data. In the settings, I'd like to display these as candlesticks with smoothing so you can observe all the structural positioning shifts without reacting to every minor fluctuation. And we will go very deep into how to interpret this layer later on because it's extremely important. But for now, just need to understand what it measures and how it is derived. Next, let's look at the liquidation bars here. Liquidations occur when leveraged positions are forcefully closed. So when a long is liquidated, that becomes a market sell. And when a short is liquidated, it becomes a market buy. So these are forced market orders. They inject urgency into the system very quickly. So now when we come down to the settings, we're going to enable liquidation bars with gradient intensity so that the larger forced events stand out visually. We keep the threshold at 0 so we can observe the full data set rather than filtering it. But you can use a filter here, but it's very simple either way because we're really just looking for spikes. Now let's take a look at the liquidation heat map or liquidation profile. So instead of showing the historical liquidation heat map, I like to enable just the profile only. This shows where current open leverage positions would be vulnerable if price actually traded into these levels. Now, this is conditional information because nothing happens with this unless price actually reaches these areas. Now, when price does trade into one of these zones and positions are liquidated, those forced closures become market orders in the opposite direction. So long liquidations turn into market sells and short liquidations turn into market buys. That is what creates the acceleration you'll often see when these levels are hit. So in the settings, we're going to enable the higher leverage bands only because they are more sensitive and they're more likely to create rapid force behavior during intraday conditions. Now I set the color map and the row height to these settings so it can be clearly distinguished from the order book profile because I use both of them at the same time. And oftentimes I will just show and hide, click on and off of the liquidation profile in case I want to hide it and just see the order book profile only. So it just depends on your personal preference and visualization preferences. But I also disable the liquidation heat map portion of this indicator because I want to prioritize the order book heat map only. This way we can see all the necessary information clearly without visual competition. Next, let's move your attention over here to this left column. This column is called the tape, or it's also called time and sells, but in Market Monkey, it's simply named trades. Now, the tape displays executed trades in chronological order. So each print you see represents a completed transaction, including the size and the direction at the time. So unlike the footprint, which organizes participation by price, the tape organizes it by time. So it allows you to see tempo and clustering of the market orders coming in. Now, in the settings here, we're also going to apply a 1 Bitcoin size filter. Now, we're doing this just to filter out noise. So that means only trades of 1 Bitcoin or larger are displayed here. This removes all the small prints and isolates meaningful aggression so the screen remains readable. You may also set up the audible alerts down here so you can hear the intensity of the market orders coming in real time instead of visually. But you'll also be able to see the color shading and speed of the tape in your peripheral vision very easily as well. So audible alerts are helpful, but they can get very annoying sometimes, but it's just a personal preference depending on how you want to use that. Next, let's go down here and take a look at the delta volume bars at the bottom of the chart. And these bars compress participation into a simplified visual summary. Now we set the highlighted threshold at 0.15, so the bars emphasized only when one side meaningfully outweighs the other. So this helps you quickly see when aggression inside a candle was decisively one-sided. But don't forget, you can also see the delta for each candle using the cluster candles with the headers enabled. So you don't necessarily need both, but one gives you numerical data representation and the other gives you a visual representation for quick visual comparisons. Now, again, everything we just covered in this lesson measures executed market order behavior only, and it also leans into positioning of these orders. Now, these tools show aggression, commitment, exposure, expansion, forced activity, and participation tempo. but they do not show resting liquidity, structural context, or acceptance, or any of that. That's going to come in the next lessons.